Hello everyone, welcome to the channel of Wall Street Mojo. Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon. Today we have a topic with us is declining balance method of depreciation. See, there are a couple of methods in accounting for valuing depreciation for basically getting the amount of depreciation, like straight line method, WDV method, that is written down method. This is the new method that I'm introducing in front of you, that is declining balance method of depreciation. Well, talking about this method, first and the foremost, we'll try and understand what is the declining balance method, the DBM method. See, the DBM is one of the among the several method of allocating depreciation over the useful life of the asset. So under this method, a constant rate of depreciation is applied to an asset's declining book value each year. So this method results in accelerated depreciation and results in higher depreciation values in the early years of the life of the asset. So this is also known as your diminishing balance method, or WDV value method. Now, other depreciation methods includes, like, we have SLM, straight line method, units of production method, sum of years method. So in this tutorial, we'll learn about only DBM method only. Okay. Now, how does the formula portion goes here? See, under the declining balance method, the depreciation is computed as the DBM. Declining balance method is your net book value less the residual value, right, into the rate of depreciation. This is going to be the formula. So the declining balance methods example we'll try and understand. Let's understand the same with the help of the example. Example number 1. Now, let's say Ram purchased a machinery which is costing $11,000. How much? 11,000. With a useful life, of, let's say, 10 years. Okay, and the residual value of $1,000, right? The rate of depreciation is, let's say, 20%, and the depreciation as per the DBM can be computed something like this. There'll be year 1, 2, 3, and 4. Then there'll be depreciation. So how is the depreciation been calculated? Well, it's based on the percentage, right? So depreciation as a percentage, then there'll be depreciation amount and value at the end of the year. Okay, so now over here, first what we can see, 11,000 minus 1,000, right? 11,000 minus 1,000, that's 10,000. So first, the total machinery amount less the residual value into the rate of depreciation, 20%, right? Are you getting it, what I'm trying to do here? Right, so this is how it is going to be. So depreciation over here, it's gonna be 2,000, right? It was 10,000 here, so 2,000, right? In the similar fashion, this 20% will be on, the next 20% will be on after deducting 11,000 minus 1 minus this 2 depreciation, right? So now it will be on 8,000. So 20% into 8,000 will be how much? 1,600. This was 2,000, right? Next, now the 20% will be on how much? It will be on 11,000 less 1,000 less 2,000 less 1,600, right? So that comes down to 1,280, and the last 20% will be again 11,000 less 1,000 less 2,000, 1,600 and 1,280, which gives us 1,024. So the value at the end is going to be 8,000 here, right? 6,400, 5,120, and 4,096. So thus the machinery will be depreciated over the useful life of 10 years at the rate of 20%, right? And as we can observe that DBM results in higher depreciation during the very initial year, and then it declines. You can see here it is really very high, and it keeps reducing as the asset gets older. Now, among the most common DBM is double declining method. See, under double declining method, two times the straight line rate is applied to the declining balance. What? Two times, right? So it is an ideal depreciation method for asset that quickly loses their value or subject to some, tech obsolescence, right? So on the double declining method, the depreciation is computed by a formula. The formula, the D double declining balance method, is equal to 2 divided by the useful life of the asset into cost minus the accumulated depreciation. So this, it does not always use asset salvage value or residual value, while computing the depreciation. However, the depreciation ends once estimated salvage value of the asset is reached. Okay. However, in those cases where the asset is having no residual value, this method will never depreciate asset fully and is typically changed to straight line depreciation method at some stage during the asset life. So let's understand the same with the help of the declining balance method. Now we are going to take an example number 2 here. On a very quick note, see, ABC Limited, let's say, purchased machinery for 12,500, useful life 5 years, salvage value 2,500 at the end of the useful life. So we need to calculate depreciation. So 1, 2, 3, and 4. Now the depreciation will be bracket is equal to bracket 2 divided by 5, right? Double into 12,500. That's going to be how much? 5,000. So accumulated depreciation over here, it's going to be 5,000. Then again the same thing, just do control D and we'll change the formula here. 2 by 5 into, you need to go with bracket 12,500 less this 5,000. Okay, the accumulated depreciation, that will give us 3,000. 3,000 plus 5,000. Now just drag it along here. Copy the formula. Over here, we'll need to deduct 8,000. So 1,800. Drag along here 1,080. So this is how our depreciation will go about. So from year 1 to 3, ABC Limited has recognized the accumulated depreciation of 9,800 since the machinery is having the residual value of 2,500 and depreciation expense is limited to the what we call as 10,000. 10,000. Why 10,000? Think about it. 12,000 minus 2,500. Right? Now it should be very quick. And as such, the depreciation in year 4 will be limited to only 200. That is 10,000 minus 9,800 rather than just 1,080 as computed above for the year 5 depreciation expense, which will be completely zero as the asset are already fully depreciated. So on this, let me make my conclusions. See, choosing the right method of depreciation to allocate the cost of the asset is at most important decision that the management of the company has to undertake. And companies need to opt for the right depreciation method, keeping into consideration the asset in question. Okay. And its intended use and the impact of the technology changes on the other assets and its utility. So DBM has its own pros and cons, and it's the ideal method for assets where the technology obsolescence is very high. And however, it is important from the investor's perspective to ensure that the accelerated depreciation method is not deployed with the intent to suppress income of the business, so due to high depreciation, and obtain tax benefits only, which becomes evident in cases where companies make large gains on the sale of the asset. So that's it for this particular topic. If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.